Joining me, Daniel Newman is the CEO at the Futurum Group, a tech-focused consulting and advisory firm trying to help clients stay on the cutting edge. Daniel, thanks for being here on the Schwab Network. Tell me how you guys, when you're speaking with your customers, find the balance between all this tech innovation that we've heard about, but now kind of a real pressure economically that's making us look under the hood of some of these trades. In the last couple of weeks, it hasn't gone so great.
Yeah, we got a real challenge right now to balance between what the Fed is saying, what the average consumer is seeing in the marketplace, and then where the strength is in the tech industry. Of course, we see a few names: Google, Microsoft, Amazon, really strong results. NVIDIA, I've said this many times before, has basically carried the past few quarters. But if you look at the macro, you zoom out, you listen to Jerome Powell talk about interest rates and staying where they are. I think inflation in the market is stickier. I think employment isn't as good as it's being described. I think that growth across most industries hasn't been particularly strong, and that we're kind of on stilts. You know, when Meta had a bad result, the whole market looked like it was going to fall, and it was only the next day with Google and Microsoft coming in strong that everybody said, oh, maybe we're okay. Same thing happened yesterday with Amazon, and then tomorrow we're going to be looking at, what does Apple do?
And that's the one that's had the toughest go of it so far this year. Any strong feelings about whether or not the market will maybe apply a lower bar for Apple, or is that just a company more generally tied to the whims of the economy now?
Look, I think Apple has had a lot of warning signs thrown. We've seen what's going on with China. Handset units are down. The company's having a hard time really determining its AI strategy. It's going to OpenAI. It's going to Google, looking and considering partnerships. I don't believe that's their long term, but they haven't been able to get it done yet. And so I think most people are expecting Apple to be a little bit softer this quarter. So we may get a reprieve there. But, you know, we're looking at the market overall. You know, just coming out after the bell today, we saw Qualcomm, we saw handset numbers. Yesterday, we saw Amazon, and the cloud number is strong. Look, AI is really strong. But against the backdrop of the macro economy, Oliver, it's not particularly looking great out there. Tech has had a ton of layoffs this year, and people aren't even really talking about that. But as I see it, we've got a small part of the economy growing really, really fast, and the rest of it is really sucking wind.
That small part growing really fast is the AI stuff, as we've seen the concentration in the market. Daniel, how much do the services and products created by AI offer a next sort of on-ramp for spending and for consumer activity? Because that seems to be one of the hang-ups, is that the last 6 months, the land grab for hardware was obvious, but the products, I mean, what are we looking at here? Some image generators, and I know it's picking up the cloud sales at these companies, but like consumer-facing products, is that going to be as big of a bull market?
Well, I like what's going on in the ad space. I think you see with Amazon's really fast-growing ad business, and of course, the likes of Meta. I mean, they have a lot of strength there. The people were frustrated with the CapEx spend, what's going on with Reality Labs, not so much with the AI. But I also really, really do like some of the enterprise software plays. I've mentioned ServiceNow a number of times. I like Salesforce here. I like companies that are going to be able to build and use the proprietary data. So Oracle's a really interesting play. Companies that have SaaS and ARR revenue, and they can build and apply AI on top of all this hardware infrastructure that we're hearing about, that is basically enabling companies to get to their proprietary, useful customer data and start creating more frictionless, better experiences and better understanding their markets. And by the way, doing all of that at lower costs, which is a little bit of a conflict in the market because it might mean fewer jobs.
Will that be able to match the growth that we got during COVID, when businesses and people were forced to stay at home, had to get all the cloud services, had to get the cybersecurity stuff, revenue booming? Will this be equivalent to that, or is this more like a profit, slow and steady grind?
I think the profits will accelerate for a small subset of companies really quickly. I think winners and losers will be separated more rapidly because of what AI will enable those companies that are able to apply generative AI tools and maximize their unique data sets. It'll also be a problem for companies that can't make the CapEx investment, can't catch up quickly enough, or maybe burdened by too much technical debt, and so they're not able to get out of their own way quickly enough. I do think the one thing that's different between COVID and the generative AI and the AI boom is that COVID didn't really see a massive change in workforce. In fact, the need for workforce was pretty substantial once the initial dust settled. I think that you've heard Arvind Krishna at IBM. We've heard CEOs put the flag out and say, there may not be need for as many people, and we haven't yet figured out what the new jobs that are going to be created by this next wave of tech are. That should be concerning. That's a challenge for Jerome Powell. But I also think AI will be a market-carrying technology the rest of this year.
Okay, so I know you keep stressing that point about the jobs, so I want to make sure to get into that a little bit here, because how much of these layoffs are going to happen at tech companies where employees have been rewarded over the last decade that are in the upper tier, like spending bracket, social cohort? Are they people looking for jobs, or are they multimillionaires that got in at these companies early? The company goes, hey, we don't really need you anymore. They cash out their stock. Where did they go? Like, is that a major hit? Do they need jobs? Who are going to be that next target to get cut?
Yeah, I don't think the folks that were at NVIDIA for the last 10 or 15 years are going to be too worried about whether or not their job gets cut. And Jensen Huang over there runs an incredibly efficient operation. You'll hear him talk about zero for their competitors is too high of a price based on their operational efficiencies. Having said that, I think it's those middle tier jobs. It's the white collar knowledge workers, those in marketing and communications, those that you can take an LLM and you can generate images or create a press release or documents for work. Again, it's not 100% displacement replacement, but it could be 60%, 70%. It could be eliminating a lot of agencies and firms that work as intermediaries, or even just eliminating parts of them. But if that's 10 or 20%, that creates a big jobs gap. And those people that are trying to replace a job that they made $100,000, $150,000 a year, those are harder jobs to find. Those are not being created here in the U.S. as quickly. And I worry about that. And I'm not sure how they're going to be created just yet. Okay, so you think the cuts will matter, will have an impact. Dan, kind of last point here, private versus public, because I know you have a lot of comment about some of the public market connections that you follow, but private markets, the stuff that we can't see, these companies that maybe wanted to IPO, but have had that hold off. How do you see that shaping up? Yeah, look, I talked to a lot of CEOs in just the past few weeks. I've talked to Bill McDermott at ServiceNow. I talked to Pat Gelsinger. And the reason I'm pointing this out is the private investment and the investment in acquisitions is going to be really interesting going forward. I think private company valuations, you saw CoreWeave got a big jump today, but that's AI. Are companies being opportunistic to buy private companies right now? I mean, I bought a number of companies over the last year, but it's been extremely opportunistic because, like I said, companies that are struggling really badly. Companies that are growing fast are growing really quickly. The private market, I think all that is exacerbated because there's less access to capital, there's less access to means for growth, and of course, when you don't have access to capital, you cannot scale quickly, and those credit markets are still tight. I don't really care what you're hearing kind of in the macro view. If you're owning a business and you're out trying to get to the bank and trying to grow a company, make an acquisition, it's not easy to do. So private markets are more complex, but we really need them because those VC deals, those PE deals, that does end up accelerating those public market size and deals. All right. Daniel, thanks for the insight, a unique perspective. Appreciate it. Nice combo of the macro with the tech stuff going on earnings. Appreciate it very much. Thanks, later. Absolutely. Daniel Newman, CEO at the Futurum Group. All right, some good thoughts there, combining our main themes for the day.